Welcome back to the podcast. This episode, we're joined by Mr. Dan Pickering, CIO and founder of Pickering Energy Partners, an energy financial services company headquartered in Houston, Texas, with approximately $16 billion invested in all energy subsectors. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This podcast episode is brought to you by EPAC, the Explorers and Producers Association of Canada. Good afternoon, Mr. Dan Pickering. Thank you very much for doing this yet again. I really appreciate your time.
Glad to be here. A repeat guest. I'm honored.
The first convo was August of 2023 online, but today we're in the Pickering Energy offices, so it's great to see you.
Likewise.
I thought for the purposes of today's conversation, we could structure it on your thoughts on energy investing, how you got into it, get into your bet on the Permian versus S&P 500, and then get your thoughts on some current events, if that's okay.
You bet.
So to go back a little bit to the investing, and was just curious, I don't know if we covered it last time on the podcast, but how you got into energy investing. I think you did your MBA at the University of Chicago?
I did. Good memory, good research. My interest in investing started before that, and I grew up in the Midwest and didn't know a lot about financial stuff, if you will, as I was growing up, but this thing called the stock market sort of came onto my radar screen as I entered college, and it was always interesting. Didn't have a lot of money to invest and didn't really know the hows or whys or what made it all work, but I was just always kind of intrigued by it. And my grandpa gave me some shares in Ford Motor Company when I was a teenager, and so I started kind of watching the stock price of Ford Motor. And my first summer in the oil patch, I worked for Phillips 66, and industry was in the dumps, as was the stock price. And after I finished work, I don't know, I bought 2 shares or 10 shares. I don't know what it was, but I bought a little bit of stock. And lo and behold, over the rest of my college, that stock went up. And that was kind of an exciting kind of time period to see actually, wow, you can buy something and it goes up in value. And so I'm a petroleum engineer. I started my career up in Alaska with ARCO, and after graduating from college, I just spent a little bit more time thinking about investing and working for an oil company. You see other oil companies. So I started tracking stocks and there's a lot of volatility in the industry in the early parts of my career. And so, just kind of paying attention to what made stocks go up and down and how your 401k acts and things like that. So I knew that I probably wasn't going to be an engineer for my whole career. And when I went back to business school, I realized it's like, wait a minute, people do this for a living. I might be able to actually work in this space. And here's how it works. And here's discounted cash flows. And here's, what equity analysts do. And here's research. And here's the kind of analysis you do to understand what something's worth and what a stock should be worth and what can move markets. All of that was just fascinating to me. And Trevor, the other thing is that you get results quickly. I mean, every day was your bet of the day correct or not correct? And not that daily results or anything you should hang your hat on, but over a month or 6 months or a year, it's like, wait a second, I thought this stock was cheap and it went up 40% in the past year. I was right. You get validation. It's not a hand-waving validation. It is a in the market, 10 went to 14. That's a win. So long-winded answer, but, this is just something that strikes a chord with me. And I love competing. I love figuring things out. And I love then not having to wait forever to figure out if your assessment was correct or incorrect.
How come you picked the University of Chicago?
Yeah.
That's a long ways from the Texas oil fields.
It is a long way from the Texas oil fields and a long way from Missouri and a hell of a long way from Alaska, where I was living when I went back to business school. So what resonated with me was a pretty rigorous, technical approach to business at the University of Chicago. So I liked that. I'm an analytical person. There's a lot of analytical components to the finance they teach there. And so I liked that. I got in. That was also, a plus. And, it was in the Midwest, and that's where I came from, so I was a little closer to family for a while. So all those things played in, but U of C was a good fit for me. I learned a lot there.
Ironically, one of the products of the University of Chicago Business School is the efficient markets theory, which is kind of contrary to what you do nowadays.
It it really is, and I joke, Eugene Fama was teaching, finance there. I didn't take his class, but you're right. Efficient market says that at any given point in time, all information's incorporated and everything is fairly priced. And so, a huge swath of the industry that I work in wouldn't exist if that were actually true. It may be true on a minute to minute basis, but as we know, particularly as information has gotten even more ubiquitous, different people invest for different reasons. Different people interpret information different ways. And again, back to this concept of one of the things I love is that people are right and wrong all the time. And I tell the people here at Pickering Energy, particularly the market facing folks, it's like, look, every time you buy a stock, someone's on the other side selling it. And they may have a different reason for selling, different time period, different return objectives, different liquidity needs, or they may be doing exactly the same thing as you. They just interpret the information differently. And so, the job of an investor is to figure out when other people are wrong. And so I'm not a believer in efficient markets because stocks going up and down every day. And I can't believe that's because the information changes that much on a daily basis.
I guess, the other point is that the markets are largely efficient, though. Did it take a
For sure.
while to figure out that difference between 100% efficient and mostly efficient? When did you kind of put that together?
Yeah. So I think you learn by experience. And so where do you get a good taste for this?
Yeah,
You get a really good taste when you're researching an idea, a stock, a company, and you think you have the edge. It's
exactly.
like,
Yeah.
this field is going to be bigger than people realize, or this company's a perfect fit with, company A is a perfect fit with company B, and so they're going to get taken out at a big premium. Whatever it is, you've got this thesis, and you really learn how efficient the market can be when all of the information plays out exactly as you expect, and the stock does nothing. It was already in there, right? And so you see it a lot with earnings results. Oh, this company's going to beat earnings by 10%, and they beat by 10%, and the stock's flat or down 3% because you didn't have differential information. Everybody else had figured out the same thing you did. What you thought was a surprise was actually consensus. So, you have enough of those experiences, you start to really appreciate the difference between an edge and not an edge. The other thing I think that's important is, bear with me on this discussion. In our business, there's alpha and beta, right? So in the oil patch, there's what does oil and gas price do? And then there's what does the company do that adds value irrespective of commodity price. Sometimes in the investing business, in my opinion, having an opinion on beta is alpha. In other words, right now, for instance, the market is what the hell is going to happen with the oil price? We've seen 72 and 57 in the past 6 months. I'm fairly bearish on oil right now, and it's ripped to the upside in the last couple of weeks from, 60 to 67, I think, today. Having a view on that beta, you either everybody's too scared, when oil's 60 and everybody's too scared and oil's going back to 70. If that's your view and it happens and you invested because of it, you made money because you had confidence when everybody else was scared of that beta. So I tend to think in energy, having a view on the macro is pretty important because it can overwhelm everything else. A great quarter when oil is tanking doesn't matter. Terrible quarter when oil is ripping, doesn't matter. So thinking about the big picture at times is really important.
When you're thinking about the big picture to make sure you don't end up speculating on oil prices, how do you make an educated guess without resorting to pure speculation?
Yeah. So I think what's really important is you don't want to make a bet. You don't want to make an unintended bet on the commodity,
Yeah,
right?
exactly.
You can't get away from the commodity in this business. And so what you don't want to do is buy a really levered gas company and not know it, or buy a really levered oil company and not know it. So understanding what the drivers are important first and foremost. Then I think the other keys are you got to just do the fundamental work. All right. What's the asset base of this business? What's its commodity price sensitivity? Inherently, one of the challenges to the business, I think, is that you can do too much work on the macro at times. You know, what's the production going to be in Iraq in the month of July? I don't know. I might do a bunch of work and get a pretty good answer on that. The only problem is that Iraq is 4% of the world's production. What about the other 96%? And, there are people whose entire lives are dedicated to figuring out the macro, and it's still really damn hard. So, doing the right amount of work on the macro, I think, is important. And then kind of knowing what are the levers that can surprise you is the other piece. And if you do that, I think that gives you can spend 25% of your time doing that and 75% on the bottoms up work around companies, which ultimately, hopefully gives you the alpha and neutralizes the beta.
Some people will call it recipe when you combine the reserves, the net asset value, discounting the cash flows, looking at management, looking ahead to the rock to see what's upcoming in the front of the windshield.
Mhm.
When you put it all together, it's, I guess, the end result. But is there a part of that recipe that you focus on more than the rest? Maybe the geology is where it all starts.
Yeah.
Good rock.
Interestingly, Trevor, geology over the last decade is an area that people have not had to spend a lot of time on because most of the market cap in energy is either in Exxon's and Chevron's, the really big companies that are diversified, and you can't do the asset level work that you do on more focused shale oriented companies. And then the shale companies now, particularly the last 5 or 8 years, the geology has been less important than kind of the math around how many sticks and how many wells and drilling cadence and all that. And so I do think, though, you're hitting on an important topic. If I think about the recipe, for me, it is figure out your macro call. Do I like oil or not? Do I like gas or not? And that helps you understand your weightings. How invested do I want to be? How much cash do I want to hold? How much stock do I want to hold? And then when you get down into the companies, I think the recipe there is a function of the underlying asset base and what's it worth, the rate of change, what are companies doing to move the business forward year to year to year, what's the quality of management, how well are they going to take care of me, and then it's where does this sit within the expectations of the market. So in other words, is this a macro I like with a management team that I think is okay, a set of assets that are a B on or a 7 on a scale of 1 to 10, with 10 being the best, that the market hates? Well, wow, that's a pretty interesting investment. Or does the market love it? Well, then it's not much of an interesting investment because it's only a 7, the management team's only okay, and everybody loves it. That's set up to disappoint. So I think you have to weave in market expectations, the actual company and assets itself, how it's being managed, and then do you even want to care about this at all, from the big picture? So that's kind of the recipe. And, the if you are if all you do is look at oil and gas investments, then you're kind of doing some of all of that all the time. It's an ongoing process.
The best teams and best companies usually are known by everyone, and everybody is aware of that. Have you found it better to kind of go to the second quartile through the years from an investor
Yeah,
perspective?
I mean, big stocks are companies that have it might be an asset that surprises you. But if you looked at, for instance, take a company like Permian Resources, PR. This was a management team that people didn't really know 4 or 5 years ago. It was a business that people didn't really know because it came through a combination of a SPAC and private equity. So it wasn't really on the radar screen. And the reality was, it was a business that wound up being run by two really sharp young guys with decent assets and a lot of hustle. And was that a second quartile? I don't know, but I think it was a pretty interesting combination of decent assets and a decent team with not a lot of understanding. That's a pretty interesting place to make money, and that's been an outperforming stock. The other thing I would say is that it's more work and higher risk, higher reward. It's what I would call bad companies getting better. So if you look at a company that has had problems with assets or stumbled on execution or disappointed the street for a period of time, if everybody thinks it's a dog and maybe the assets are okay, or maybe there's a change in the management team, or, the wind just kind of blows in their direction. If you're paying attention, I mean, bad companies getting better can make you a lot of money because everybody hates them. They're probably trading at a discount on both asset value and on multiples. And as the rest of the world wakes up to the fact that it's not as bad as they thought, there's just a lot of room for improvement there. Because what tends to happen is if the assets are being run more efficiently, the cash flow improves, the multiple on the cash flow improves, and you get, kind of the double whammy expansion.
Energy has been extremely volatile well, it's always volatile, basically. So, from Pickering Energy Partners' perspective, which may be different than your own portfolio, maybe not, how do you think about concentration and how many names do you look at? How many do you put in your portfolio?
Yeah. So I started my career in energy finance, if you will, at Fidelity Investments, and one of the which was an amazing place because everybody's a bunch of stock pickers and they love to dig into companies. And one of the guys that I worked with that was probably 5 years older than me at the time, he actually is still 5 years older than me, but he had 5 years more experience than I did, was a junior portfolio manager. And he said, diversifications for wimps. That's one end of the spectrum. The other end of the spectrum is, particularly when you're looking across all sectors, there's value to diversification. When I think about energy, I tend to think that if you're going to play, you want to play to win. So if you think that the beta is in your favor, you want to play to win, and diversification probably costs you money because you're trying to reduce risk in a sector that's either risk on or risk off typically. And so my approach is a fairly concentrated strategy. I don't think there are not 100 good energy names to own, even when the wind's at your back. And so I think as a diversified investor, you look at energy. If you can't narrow your portfolio down to 5 or 10 good ideas, then you're probably kidding yourself. And if all you're running is an energy portfolio, I still think, 15 or 20 out of the universe, because otherwise, are you really finding alpha or not?
Yeah. And as you go through that process, what does it look like? Is it a manual with energy names in North America? Where do you start? How does that process start at Pickering Energy?
Yeah, great question. So different strategies within the firm. I run a small long only portfolio that's really an oil and gas portfolio. Our Sailing Stone team runs a more diversified natural resources book. So speaking for myself, and the Sailing Stone team, by the way, has had great numbers diversifying across oil and gas and minerals and metals, mining, et cetera. But when I think about the portfolio construction process, kind of the same way, there's a macro, do I want to be involved? And within that, what subsectors depending on where we are in the cycle, the advantage shifts between the subsectors. When folks are in a drilling frenzy, the oilfield service companies have pricing power. When a basin's oversupplied, the midstream has the pricing power because they control the egress. So, the earnings momentum can shift within the subsectors. And so try to think through that. Same sort of story, how much exploration risk do you want versus, production-oriented companies? And then there's just where do you think you can comfortably do the work? So my portfolio has almost always been predominantly North American because I feel like I've got a better ability to understand those companies. It takes me fewer hours to get to the management teams of most North American companies than trying to go get an edge on somebody that's listed in the UK or Norway or Argentina or Australia. So, and so my fear is always in a person who believes that you can find an edge a la non-efficient markets, then just the ability to gather information is just much easier when you're closer to it. So I tend to be North American. My subsector exposures tend to be a function of where the business cycle is. And there'll be times when I'll own no midstream. There'll be, because either the groups run up or the valuation. You always have to put valuation in context as well. And so you start sifting through what subsector do you want to be in, how well you do the companies, back to these other stock-specific issues, management quality, valuation, et cetera. And I think that your kind of portfolio sort of falls out of that. If you're going to run a 15 to 20 name portfolio, you got to be comfortable owning 5, 6, 8, 10% in a few names. And so you try to size that portfolio or those positions based on both your kind of risk tolerance and the upside, that those individual stocks have.
This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. So when you pick up 15, 20 names in North American energy markets, there's not many names, relatively speaking, to pick. Maybe 30 in Canada, and I don't know how many you classify in the States as investment grade. There's lots of eyes on the market. So what to you what's been the best catalyst through the years that you've seen? Because there's lots of people looking at the markets every day that are smart and do the work too.
There are. One of the things about today's energy markets, my opinion, yes, there are lots of people looking. One of the best ARBs in the market today, the best value opportunities, is that most of the energy dedicated investment professionals sit within long short hedge funds that are taking very low market exposure, these market neutral pods, if you will. Those folks are very data point driven. Anytime they find a great long, what do? They pair it up with a short. And so I think one of the more so I think that those folks can be longer term focused, but oftentimes aren't. The majority of them are going to be involved in something for 2 months, 3 months, 6 months. So the ARB is all the money's swashing around. Somebody has a bad quarter. Everybody decides to short it. That stock may get really cheap. And if I'm willing to own it for a year, I don't have to care about the missed quarter. So I think one of the opportunity sets today is just having a slightly longer time frame. So that's one area of finding success is when everybody's rushing to one side of the boat. If somebody gets thrown out with the bathwater, I'm happy to pick that up. So I think arbing time frame is one way to make money. The other is having a decent handle on value and relative value. So just because a stock's gone from 50 to 30 doesn't mean it's cheap, because things may have changed with the company. And so the real question is, when you look at something and the peer group is trading at 5 times and it's trading at 3 times, why? And if you get comfortable with the whys, owning cheap stocks versus owning expensive stocks tends to make money also. I'll give you a quick example. This is not a cheap or an expensive discussion, but it's a one side of the boat versus the other. The Venture Global IPO, they did a horrible job pricing that. It was mispriced. It blew up. Everybody hated it. Then it kept going down. Then everybody that was involved on the IPO has been blown up. They bolt because they were playing a deal that didn't work. They missed the first quarter out of the boat or out of the gate. And that thing just got way oversold. People shorted it because of all of the, kind of negative news flow around how the stock was performing. I don't necessarily have a firm view on Venture Global as a 5-year story, but there was definitely an interesting view on this thing's probably beaten up too much just on market dynamics. And so, that stock's doubled off the bottom. And I don't know if it doubles again, but that's an example of it was cheap enough, in single digits, and you knew that all the market dynamics were against it. And so that was kind of an interesting trade where you look for people off sides.
And so speaking of long term, getting to the bet you made, circa 2020, if I'm correct, you made a bet with Quick Draw Capital on a basket of 6 Permian producers. And the bet was that they would outperform the S&P 500 over a 5-year period. That was an example of good energy investing. So I guess the question is, why did you make that bet?
Yeah. So, we're in the Wayback Machine now. So Twitter was a bit of the Wild West in that, kind of during COVID. So there's a lot happening in the whole market, in the energy markets, and in everybody's lives. And so there was a big discussion as COVID was coming and oil prices blew up and went negative. And there was a period, that was also a period of time when Shale was being, the emperor kind of has no clothes was sort of being, we were realizing that, not every well has a 1 million barrel EUR. And so there were just a lot of things happening in the oil patch and in the market and in Twitter. And, when this is all you do, at some point you also get frustrated because you sit there and watch, you watch stocks trade from, 100 to 10. And at some point it's like, damn, these things, this is too much. And so we hit one of those moments, and I can't remember exactly what I said, but I basically said, this Permian's the lowest cost basin in the U.S. The assets here are generally pretty good. The market's thrown them out equally to other basins and thrown energy out overall. It's like, this is overdone. It's too much. And at the time, this person, Quick Draw Capital, who was also very active on Twitter and very thoughtful and, had lots of interesting takes, basically their view was, they took the other side and said, I think, the Permian could be done. And so in the classic sort of, okay, I have one opinion, you have another opinion. Then if you believe that, let's make a bet. And so I don't know if he proposed it or I proposed it, but the bet was you get the S&P and I get these 6 or 7 Permian companies. Now, Trevor, I was an idiot because I just took the price of the stock. I didn't get dividends. I didn't get anything.
I read that.
I just got the price of the stock. And Quick Draw got the S&P 500. And so we said, doing it for $1 doesn't make any sense. And making a money bet doesn't, I have no idea if this guy's a billionaire or, a pauper. And so is a $1,000 bet or a $100 bet or, is a monetary bet really mean anything? And so bragging rights and a big steak dinner in New York was what we chose to bet on. And not only did I win it, I won it convincingly. And what I love about that, one, I love to win. 2, I love to talk trash. And I got to do it for about 75% of the bet because things rallied back quickly and Permian was doing great. but you get, right, you get to see it all unfold. That was really, really fun. So talking trash was probably the most fun of it, though.
And so the value prop from your end was that the Permian was a low cost basin. Oil prices were historically depressed. And as a result, the next 5 years, those stocks would outperform on the way back up.
I just couldn't see how I believed then, I believe now. The world was uncertain, and so you didn't know what was going to happen to oil demand. But I think my view was energy's too important to not be needed. The Permian's too important relative to the overall energy equation. And so I didn't take a high cost basin, I took a low cost basin. So I just felt like everything was stacked on my side. And at a minimum, what it also makes you do, right, there's a thought process, well, what's the market going to do? And so, I'm a big believer that we run a stock contest, every 6 months internally at PEP. We pay out prizes for the people who do the best. I want people thinking about markets. We don't do this in a vacuum. We have a capital markets business. We need to think about the market. We need to think about relative values, and we have to think about our sector versus the broad market. And so, that bet made me do it at the beginning and keep paying attention to it along the way.
And for the listener, you are up about 200%, which I calculated is almost 30% compound annual growth rate compared to the S&P, which was up roughly 100%, 15% compound annual growth rate. So
we killed it off the bottom, and, hooray. But I think there's an important takeaway here, which is in a cyclical business, when everything blows up, that is a burning building you want to run into, because most businesses aren't going away forever. And so whether it's autos or paper or tech can be cyclical, although people haven't experienced that in quite a while. When things blow up, when you're down 70, 80, 90%, which can happen, we had a really bad commodity tape. We had a really bad market. Everybody was terrified. When that happens, and it wasn't 5%, you don't make that bet down 5% or even 20%. You make that bet when the world thinks you're done. And typically, things aren't done. And so we'll have another one of those. In the next 5 or 10 years, there'll be another downside panic. Who knows? Maybe it comes in the next 18 months. But that's when you want to run in, lean in, invest. And the flip side is also to remember, as bad as that felt, when it feels the opposite, that's when you want to run out. So investing in cyclical businesses, you want to look for sentiment highs and lows and go the other way.
But to quick draw capital's credit, it took a once-in-a-lifetime pandemic with depressed prices for that bet to outperform the market. Do you think it's possible for an energy bet to consistently do that?
Actually, I think it is a tough sector to consistently beat the market. And so, now, early in my career, I love this space. This is what I do. I want it to always outperform.
Yeah.
And
This is an energy podcast. So.
yeah, that's right. And technically, I'd like to think that I can stock pick my way to beating the market all the time. History would show that it is really hard to outperform when the macro is going against you. And so that's why it's important. That's why I think about it first at times. And so I think that there are periods of time when this is among the best groups in the market. And there are going to be periods of time where you're not going to be able to win. And the only chance you have as a buy and hold for 50 years is you'd better find companies that are truly have a resource base or doing something special. If we went back and looked at, I should know the answer to this. If you go back and look at Diamondback from IPO to current, I bet it's beat the S&P 500. Why? Because they started out as a tiny company in a pretty good space, and they made things happen in a big way over the course of time. Not every company is going to do that. Not every, they are the outlier, not the average. So the answer is you're not always going to be able to win.
Right. But you can.
Pick your spots. Yeah. Pick your spots.
And on that note, are there certain basins or groups of stocks you're looking at nowadays along those lines?
Yeah. One of the challenges, so most of the energy sector, most of the attention in the energy sector today is all about shale, U.S. shale. And frankly, the differentiation of companies in the U.S. shale sector is really tightened. There was a period of time where certain basins were notably better than other basins. There was a period of time when the industry's approach to cash flow was different. Now, pretty much everybody's got a 50 to 70% return of cash finance framework. They're all living within cash flow. They've all got a dividend. They kind of all sound alike when you listen to the conference calls. They all have enough inventory in the near term that you're not worried that somebody's going to completely fall out of bed because they start drilling really bad wells. So it's getting harder to differentiate these companies. I think that differentiation is going to emerge over the next 4 or 5 years as shale starts to mature. Who has good inventory, who has bad inventory? Two companies that both have investor presentations that say they have 2,000 sticks. Not every stick is equal. We're going to find out. But that your question was really, are there places that are differentiated? So the answer is differentiation's tough unless where you find different things is you find them in different geographies.
Like Ohio with EOG.
EOG's making a play there. You couldn't get that exposure with there's not many small or many public companies there. But the world is eventually going to have to go back to non-shale places, whether that's Argentina or offshore or international from a U.S. perspective. It's still a little early for that. We just did a conference in Colorado where we looked at, we called it putting the E back in E&P. It still feels early because there's still some running room in shale, but at some point we're going to have to figure out how to read maps again. You talked about geology earlier in this discussion. We're going to have to do more on geology. We're going to have to think about traps and faults and stuff that we haven't thought as much about because shale's been just much easier to analyze. So I think there will be a time for looking abroad and looking at non-shale plays. And, what am I interested in? I don't think oilfield service is cheap enough yet. I think midstream has kind of had its good run. Upstream's not particularly differentiated. And so you really start digging down into unique names. I'm intrigued by what Jim Flores is doing in California with Sable. The stock's going from 15 to 42 to 24 as they've fought the various regulatory things. You start looking in Argentina at some of the stuff that's happening down there. Vista's a company that's listed here in the U.S. that looks kind of interesting. The macros are, I think, an overhang for all of this, but, I'm intrigued by the implications of AI on the oil patch, but that sector's had a hell of a run. All of the AI adjacent energy stuff, the GE Vernova turbines, the power providers. There's a shale boom that's happening in power. It's going to last for a while. It's pretty expensive right now because everybody's excited about it. But, I'm trying to get smarter on that stuff for when, we have the inevitable pauses in those companies. So power's interesting. Gas continues to be interesting, at least for the next 18 months because of the LNG stuff. And I think shale's a little bit generic at this point.
This episode is brought to you by Astro Oilfield Rentals. Planning your next drilling or completion site? Astro has your remote communications and accommodations needs covered. With over 25 years of experience serving Western Canada, Astro continues to expand, innovate, and deliver the best value for your investment. Astro offers a full range of communication solutions, including cell towers, radios, and internet services. Astro's lineup features well site trailers, sleepers, full gym units, medic centers, and custom-built command centers, helping you stay connected and comfortable in even the most remote locations. Visit astrorentals.ca for virtual tours and more information. So speaking of shale, bringing it up to some current events, there are some influential investors that would say shale is not working sub $65 WTI, maybe $60 WTI. What do you think about that? Is that true?
There are plenty of locations that work at sub 65 or sub 60
U.S. shale?
in U.S. shale. There are plenty of locations. Or I sure as heck hope so, because we have 400 rigs, drilling for oil right now. They can't all be drilling uneconomic wells right now. I think in aggregate, shale doesn't work great at 65 or 60. And so I think the outcome of that is we spend time. 65 is not going to shake people off their drilling plans. 55 will. I think probably we're going to have 55 to clear the market. My expectation is U.S. production is going to have to go down 1 million barrels a day and to make room for OPEC production. So I think, Trevor, my view would be that shale is maturing. The number of locations or the number of rigs you can work economically at 65 is declining. It's not zero. And so I'm expecting, if OPEC keeps coming, and we got to make room for their barrels, the most price-sensitive quick cycle barrels are in the U.S. And if we need to make some room, what creates that room? Price does. 65 is not going to turn off the U.S., so we're going to have lower than that. And when we do, we'll see continued revisions downward in activity and spending until we find a better equilibrium.
Today's June 11th, however. This convo may air in a couple weeks.
Yeah.
But we're up to $68,
I know.
70. So why?
It's the humbling part of...
It's random.
Yeah. It's not random, but the thing is, if we could easily predict prices, we'd be billionaires and own islands. It's really hard. And I think what have we had? We had wildfires that made production a little tougher in Canada. We have a Chinese-U.S. tariff agreement that makes people feel better on the margin about worldwide economic growth. We've got potentially, we have the president saying, I'm not necessarily happy with what's happening in Iran, so maybe some barrels are going to come off there. And so we've got, and we had people that had gotten pretty pessimistic. I'm in that camp too. And so you get pessimistic, and I assume people got fairly short, and then here are these few data points, and it rips your face off 10% to the upside. The question's, what's sustainable? So now I'm back to the big picture macro. I thought we had 1 million barrels a day of supply and demand increments in 2025. And then here comes OPEC. 140,000 barrels a day, 411, 411, 411, and signaling another 800 in the next couple months. You got a balanced market, meaning supply and demand are pretty equal. Now you've got 1 million to 2 million of OPEC quota barrels. It's easily 1 million plus of actual physical barrels. So you can put them in storage, you build inventories, but at some point, you just got too many barrels. When that happens, price typically goes down. So yeah, we're up 10% here in the first part of June, and it's hurting people. And, I write a commentary every month, and I talk about oil going into the 50s, and here it's going the other direction. And isn't that embarrassing? But put a 7 handle on crude in the next month, and I'm probably ready to make another bet about 80 versus 60, which comes first. My conviction would be growing that we're getting a little out of bounds to the upside if we keep going from here.
The argument is that sometimes OPEC, the strategy was that you flood the market, crash prices, shake out American producers, and some Canadian ones as well. However, Canadian and American producers have been resilient, and they've found ways to keep producing efficiently. How do you price in that optimism quotient? Do you ever think about it that way?
I do.
You can't discount that.
Yeah.
Everyone's pessimistic, but
I think they have good assets.
Yeah.
And they have competitive assets. So it's not the barrels you've already turned on that you're going to turn off. It's that next well.
Yeah.
And the issue is globally, that next well has been planned for the last 2 years and contracted with a drilling rig for the next year. And that's a project that you can't, that's a ship you can't turn very quickly. You can turn it pretty quickly in West Texas or, in the shale plays in Canada. And so if you get the price signal, we already have the framework. Companies are not going to spend more than their cash flow, period, end of story. So if the price signal pushes down cash flows are going to push down investments and people start to slow down. Are they going to turn back on quickly? You bet. That's the optimism piece. The optimism piece is I got good assets here. They may not be great at 55, but some of those assets, they weren't drilling when oil was 75. Why? Because they wanted to give the money back to shareholders.
Yeah.
So they're assets to be drilled. The question is, within this framework, will they slow momentarily? And I think the answer is probably yes.
The argument is so the Trump pump for Trump is that you need low oil prices to get reelected in a nutshell. However, this isn't the best thing for industry at times. How do you balance those two thoughts for the consumer versus industry?
Yeah. This industry's job is to deliver a product to people that want it. And their job is also to make a good return for their shareholders. Their job is not to have cheap energy. It's not the responsibility of the industry to deliver cheap energy. Their job is to deliver energy at whatever price delivers a return, and global supply economics will, supply curve will tell you what that price winds up to be. So the industry didn't react to pump for Trump or drill baby drill because that request made no sense. Okay. I get the low prices are good for consumers. Great. I get that more energy production in North America creates better geopolitical toolkit for the administration. But thankfully, we're still in a world of free will. And so drill, baby, drill is definitely, it's not even shooting yourself in the foot. It's like shooting yourself in the leg. It's worse than the foot because more supply for the industry translates to lower price, which translates to lower cash flow and lower returns. And so to ask the industry to sacrifice, I don't think made any sense, and the industry didn't listen. We wound up with lower energy prices, and OPEC is the kind of key driver there. They have different motivations, and they may be playing a great long game, Trevor, because they're creating shales pulling its foot off the gas or foot off the accelerator, however you want to think about it, and which ought to stimulate, the lower prices ought to stimulate demand. Shale's losing momentum at a time period when probably shale maturity is closer. So the asset's not as good, the activity's not as high, the recovery will be harder, demand ought to be going up, and OPEC's getting their barrels back into the market, which means the next incremental barrels will have to be drilled for somewhere, which probably means higher prices. So maybe OPEC's got a 5 or 7 year game that makes them more money by taking pain in the next 18 months. I think it'll certainly be painful for us, but as long as capital discipline's in place, drill baby drill is only going to be created by a price signal. And that's not a $65 price signal. It's going to be a $80 price signal.
And demand keeps going up. I think it was the OPEC boss was in Calgary yesterday predicting 120 million barrels a day by 2050.
Yeah, that's maybe a home team estimate, right?
Which good direction.
Yeah. I mean, I think for a while, the world thought that demand was going down and going down quickly, right? BP said 2019 is peak demand. I think what we're learning, and there's a ton of smart people that talk about this, is just oil and gas remains the cheapest form of energy. And there's billions of people in the world that can't pay the same price or high price for energy that developed countries can. And so low price energy is probably going to win and demand's going to go up. And so I don't know if 120 million barrels a day is the right number, but I think oil demand goes up for the next 15 years. That makes it 2040. It's hard to see beyond that. Is it 120? Is it 115? Is it 110? It's not 104, which is where we're at today. And I think importantly, what we energy nerds all talk about and know is decline curves are real. And so it's not the incremental million barrels a day that's tough. It's the fact that we lose 8 or 9 every year that we got to replace. And our exploration spending is abysmal. Shale's been a huge part of that story, and shale is plateauing, toppy something. And so, which goes back to my point of, I mean, maybe the OPEC guys do win because they've got better reserves and, an ability to take half or more of the next 5 million barrels a day or the next 10 million barrels a day. So I think demand's going up. I don't know if it's 120, but it's not going to be 80. It's not going to be 90 probably in 2040. We got a long, long glide path here for oil demand.
And so on the subject of decline curves and tiring shale and inventory, since this is a Canadian podcast and there's lots of energy companies in Canada with tons of resource, why don't you think, or do the American companies look up north? Are they starting to look up north? What do you think about that?
Yeah, I think that that's an inevitability. So there's a lot of resource. Why hasn't it happened yet? Because U.S. companies, for the most part, are afraid to come out of basin or out of their little focused area. Why are they afraid? One, they still have a pretty decent amount of resource themselves, but coming out of basin sort of says, I don't have enough here. And that's a message I don't think companies are excited about delivering yet. But when you look at Canada, it has resource, it has an attractive valuation. You're starting to see private equity, U.S. private equity nose around up there again. There's been consolidation in Canada somewhat already. But my thesis is that if we looked at the last 20 years, kind of shale 2004 to 2025, companies went from being diversified in, geography and commodity. They were oil and gas companies. And then they became North American oil and gas companies. Then they became U.S. companies. Then became Permian companies. Then they became, a specific county. We really concentrated because there was so much resource to develop. As the resource gets a little bit more scarce, you're going to have to either decide, am I just going to blow down my business? Or am I going to step out and step away and step up? And so my guess is there will be more diversified energy companies in 15 years than there are today by a lot. And they will have done cross-border consolidation. Oil companies will own more gas and vice versa, and we'll have fewer of them. And that to me feels like the logical cyclical reaction to everything that we've done over the last 20 years. We sort of undo it over the next 20 because we'll have to.
The last 10 years or so, the Canadian energy federal government has been hostile towards traditional energy. Do you think that has played a role in the hesitancy of U.S. investors?
It doesn't help. I mean, I think the reality is that U.S. investors went away from this space. And they abandoned the sector because the numbers were bad, the stock performance was bad, and then because, we were at 10% energy component of the S&P, and it's now 4%, and so along the way, folks don't need to care as much because it's just not a big component of their benchmark. And so, okay, I own Chevron, I own EOG, I own Schlumberger. I don't need to go to Canada and own Strathcona. I don't need to own C&Q. I don't need to own companies away from, my very tight little benchmark. And so the muscle memory of and knowledge of things outside of the U.S. shale patch has gone down a lot. And there has not been any, to date, there's not been any compelling reason for a diversified investor to really dig down to start going, you know what? I think I've looked at all the U.S. names. I own 20 of them. I need more juice. I want to go own something in Canada now.
Right.
We just haven't had the catalyst for that.
Couple questions from Max as we get towards the end.
You bet. Sure.
This one comes from Quezo.
Okay.
kind of already covered it, but where do U.S. shale players head next?
Yeah. I think for the next 2 to 3 years, probably. My base case assumption is the next 18 months are harder or worse or more challenging, whatever you want to say. But I think for the next 2 to 3 years, they do the same things they've been doing and probably quietly think about what's next. Is it a Permian company that makes an oily acquisition? Is it like EOG that, makes this Encino acquisition? So is it an oily company that comes out of basin? Is it a gas company that thinks about, Montney in Canada? I think they start thinking more about their diversification plans. And I think the other piece is in the next 2 or 3 years, one of the avenues for some of these U.S. shale guys is going to be continued consolidation. I think more of them will go away. So status quo, laying the groundwork to sort of be different as we move into the kind of 2030s.
And there are some deep pockets in the States. Do you see the investors looking to the market to purchase the barrels, potentially really cheap in Canada, or is it inventory?
I think the Canadian story is going to be Canada plays kind of like the U.S., which has been the industry consolidates because investors won't pay up, right? If I'm going to be valued at 4 times cash flow, great. I'll buy this other guy at 4 times cash flow and wait to trade at 6. So I think that I think Canada continues to probably consolidate somewhat in the near term, and then we'll see if the cross-border stuff starts to happen.
I really appreciate your time today.
Yeah, Trevor, that was fun. Enjoyed it.
Thank you very much. Maybe to wrap it up, advice to an energy investor June 11th coming into the summer. What would you tell them?
June 11, 2025. What do I tell an energy investor? I think this is a time to be selective in the things you're doing. I think, one, what is your mindset? The mindset is, if the world gets worse, am I a seller or am I a buyer? And I'm going to be a buyer in this environment because of all the things we talked about. Energy demand is going to recover. OPEC's getting their barrels back into the market, removing that overhang. Shale's starting to mature. Somewhere in the next 5 years, and it could be the next 2 or 3, there's going to be a nice, really big upcycle. And so what I don't want to do sitting here in June of 2025 is I don't want to watch the market soften, get too afraid of it, not get invested, and then go, oh my God, I can't believe when oil was 54 that I wasn't buying something. So, the mind's put on that Teflon hat that says, I'm ready if things get worse.
Maybe we'll do part 3 in a year or 2.
I would love to do that. Thanks for the time today.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. Until next time, happy coffee drinking.